Hello and welcome to another edition of Deal Hunter. I am so excited for our guest today to talk about something other than real estate. Our friend Morgan Poloton from B Capital. Nice to have you.
Nice to be here, Mitch. Thanks for having me.
Yeah, we really appreciate it. Tom, it's always good to see you. It has been a while in person. You've been traveling quite a bit. What have you been up to, my man?
Oh boy. We are just about to launch a major PR campaign. The city of Lockhart, I've been acquiring land down there for some time. We have about 1,000 acres. We got the green light to essentially build a second Lockhart from the mayor. So hospitals.
Congratulations.
Yeah. A lot of work ahead of us, but probably an $8 to $10 billion 12-year legacy project that we'll hang our hat on and say, did it, mom, look at me. And then that's about it. So.
Well, I don't mind the time frame. I think it's definitely an uneasy time in all asset classes. And we wanted to bring Morgan on to really kind of give us an idea of what the venture space looks like. BCAP, they're one of the more successful venture firms out there. Morgan, I'd love to kind of know a little bit about your background, how you ended up at B Capital, and perhaps give us a little idea of perhaps the investment thesis that you guys run with.
Absolutely. So I've been investing in venture for about 7 years. I kind of had a roundabout way of landing here, which is that I was actually a software engineer before going over to the dark side, and got kind of randomly recruited by a firm, Bloomberg Beta, who took a shot on me. And that was a 2-year stint. I found out I really liked it, so I stuck around. After Bloomberg, I went over to Comcast Ventures, where I spent 3 years doing a little bit of everything, so both B2B, B2C, early stage and late stage. And then I joined B Capital in March of last year to help out with our newly announced about a month ago early stage fund. It's called the Ascent Fund. It's a $250 million vehicle focused on seed and Series A. And to tell you a little bit about just the firm broadly, so we are pretty new on the scene. We were started in 2015 by 3 co-founders. So Raj Ganguly, who's an executive at Bain, along with Eduardo Saverin, who's the co-founder of Facebook, and Howard Morgan, who's a co-founder of Renaissance Tech and First Round and Idealab. And so we were started in partnership with the Boston Consulting Group. So we have an operating partnership with them. We bring them in post-investment to help our portfolio companies grow and scale. And today we manage a little over $6 billion in assets that's split across a family of funds. So we have later stage funds, we have domain specific funds that only invest in healthcare, geo-specific funds that only invest in China. And our newest fund is, as I mentioned, early stage fund.
Thank you for that background. Let me ask you this. Primarily, is this a in-house funded are these in-house funded funds? Are you guys managing capital for institutions?
Yeah, institutions. We have a number of LPs, kind of the usual suspects, lots of institutions, family offices, primarily.
So talk to us a little bit about the investment thesis, perhaps, something that you may have learned over at Comcast before you jumped to B Capital, and perhaps maybe how that's different. And, obviously you've been in the VC world, I guess on the shorter time frame, but certainly, I don't know if the venture timeline is like dog years for one year equals 7 real people years. So give us a little idea on the investment thesis of perhaps Comcast and maybe how that differentiates at B Capital.
Yeah, well, I'll start with B Capital. There's a very clear thesis, both at the firm's founding and now, which still is intact, which is, so at 2015, I don't think there were any funds who were investing globally and across a company's life cycle. And so, globally, obviously in every major market, and then by across a company's life cycle, we mean from, seed stage, founding, pitch deck, pre-product, pre-revenue, all the way up to, IPO and exit. So that was the thesis for the fund. It rested on an assumption that, globalization, has been a major impact in the world and will continue. And most of the venture industry is focused very much on the US. And so I think that the three founders saw a gap in the market and decided to partner with BCG to execute on that because BCG has offices in 80 plus countries, been a global consulting firm for a very long time, and had a lot of expertise in helping traditionally enterprise companies expand, but wanted to apply that expertise also to emerging enterprise companies. And so that's still the thesis. And so we just been laying the building blocks there. And now with our seed and Series A fund, we now have that every stage covered. And I think this year we made our first investment in Africa. So I think we have pretty much every region covered as well, outside of Antarctica. So it took us 7 years to get there, but I think it's exciting times ahead.
Yeah, Morgan, let me ask you this. Yeah, so just real quick. So are these funds are these evergreen funds, or do you have windows capping the raise time?
Yeah, it's a traditional LP GP structure with committed capital. And so our latest growth funds be north of $1 billion, and we kind of like every venture firm will be raising subsequent vintages every.
Yeah, and are you the other podcast, All In, fantastic podcast, but now that I think firms are pulling back on funding, are you having issues deploying capital fast enough to meet your prospectus, or what's the scoop there?
No, I mean, it's a great question. I love All In. It's part of my favorite podcast. No offense to you guys. Maybe you guys are good there. It's my first exposure here, so let's see.
Well, they don't have the hair like Mitch does, so.
That's true. That's true. Best hair in podcasting. So the short answer is no, actually. So things definitely did slow down post the market meltdown, just mainly because everyone's just trying to make sure their portfolio was in a good place, figure out like what the hell was going on, and so that slowed down deal making. But the fact is that there's a lot of capital that's been raised, and it's been sitting on is ready to be deployed. And so, we've seen things pick back up, frankly, in the last month. And not to say that it won't tick back down again if something happens in the macro environment that is bearish, but I don't worry that that things will kind of grind to a halt in the private markets. And of course, it definitely differs by stage, right? So if you're a late stage investor aiming for an IPO in 2 years, and then public multiples crashed by 70%, like that impacts you more than if you're where we are at the Ascent Fund investing in seed Series A companies, where we don't think they're going to exit for 7 to 9 years.
Yep.
So Morgan, one of the things I'm very interested in, so I am part of a very small venture fund called The Fund, which is an offshoot of Techstars. And, we've got a small $1.5 million fund where we do micro investments. We literally write $50,000 checks. It's probably more about the ecosystem. And we've obviously got some prominent LPs here in the Central Texas region that help facilitate, foster these companies to get to that next stage, perhaps a Series A. One of the things, that I'm curious about, we're $1.5 million. We write $50,000 checks. You can do the math. It takes 30 portfolio companies to have an interest, which takes time. We've been around for, I think, 6-7 months now. With this latest fund here in Austin, and we've only deployed, I believe, 6 or 7 checks. So how do you put that $250 million to work? I'm very curious about that.
It's a great question. I mean, to be honest, I think maybe we've had the privilege of having the opposite challenge, which is how do we make sure we deploy over our entire investable period and not pace too hot. And that's, because I think we do see a lot of great founders and opportunities coming our way. And so, I'd say for most of my investment career, for that matter, it's always been the opposite challenge, which is to make sure the capital lasts as long as it should. But, look, it's a different, a bit of a different beast in terms of like Bloomberg and Comcast having brand names, and, B Capital been around for many years. And, we have 35 plus investment professionals, all who have, many years of experience and relationships and network where most of those deals come from. And so, I think it's, for new funds and for a smaller one, it will take some time. But I think, the the kind of rule of thumb or like rough stats looking back when we've done this analysis is, we might invest in 1% of deals that we see at the end of the day. And so, we probably look at, 1,000 deals a year. So most of it is about, I think, picking and then, winning the ones that you pick.
I'm fascinated by that because I feel like I get pitched twice a day and I might see 50 to 100. So it must be nice to fully dive in. When founders approach you, I mean, I assume you guys with the Ascent Fund specifically, do you provide an ecosystem to kind of nurture and foster these portfolio companies? How do you guys invest? Is this a strategic investment or are you guys more passive where you just find the right founders who just have it already? Perhaps they've already graduated from some accelerator program and they're ready to go. And you guys are coming in alongside of some of the other venture funds out there.
We like to be pretty hands-on and active. And so, we prefer to lead or co-lead rounds, which typically means we'll take a board seat and be pretty involved in the company. We have an amazing platform team at B Capital that helps with, everything from, hiring and marketing and sales and PR, budgeting, capital formation. Like we have a really great team. So in addition to the investment team being involved at the board level, we have the platform team to help. And then externally, as I mentioned around the partnership with BCG, we bring folks in there as well. And that can be, anything from a 30-minute call with a domain expert to, especially for our larger portfolio companies, like more full-fledged engagements on strategic issues. So we do consider ourselves very active investors. I would classify us as active financial investors, given that our job is to get ROI for our LPs as opposed to strategic benefit for a corporation. But yeah, we do kind of roll up our sleeves as much as we can, and so we'll have like a more consolidated portfolio relative to a more passive investor. There are different models, nothing, not right or wrong, but just affects your strategy.
So you guys are taking pretty big bets, and that was kind of my next question. How many companies are you going to actually seed with $250 million? I'm just curious to what the attribution of one company and perhaps maybe what the success looks like, or what you hope to look for in a company. They typically refer to, a 20 bagger in the VC world. And you obviously have that one uni or decacorn that perhaps picks up, a lot of the, ones that perhaps don't reach those crazy milestones, but perhaps still significant businesses.
Yeah. So we're looking to do probably 30, 35 companies in this fund, maybe 2/3 seed, 1/3 A. In terms, it's still too early to know kind of how the distribution of returns will play out. But as you guys know, VC is very much like a grand slam business. And so power law is very much in effect. Well, if we're successful, we'll probably have, one or two companies provide most of the returns. That's generally how it works out. And then, hopefully we have, another 40% or so, 50% that have kind of good returns. And, we expect to have obviously losses as well. And so kind of the rule of thumb that I've always thought of is, a third losses, a third, 1 to 3x, and, a third 5 to 10, maybe 1 or 2 really explosive ones that make the fund to make up for those losses.
That's perfect. That's great insight. Tom, I don't know if you had anything to add.
So just a few questions, some pretty simple. One, I'm just kind of curious, I can probably find this on a news article. Where are you seeing the most amount of volume of opportunities come out of the United States right now? And then maybe just more holistically, maybe if it's outside the United States, which other countries? I know like Israel's very heavy right now in a lot of tech innovation. Two, I'm curious to know if there was one main attribute that you look for in opportunities, what is it? And then just why?
Yeah, so maybe answering the last question first, I'd say if I had to pick one, and of course we look at a multitude of factors, but rocket person founder or founders would definitely be number one. At the end of the day, it all comes down to people. Everything else we look at is driven by the people, who are founding and running the company. So any metrics, any, market size, any competitive analysis, et cetera. If you have really great people at the helm, they'll have done that thinking and made good decisions around that. So definitely people. It's not an original answer. I think many investors will tell you that. In terms of sectors in the U.S. and abroad, so in that 80% of our portfolio that really focuses on B2B software, we do like a few themes. So vertical and horizontal SaaS, fintech, digital health, and industrials are probably our main four, and see a lot of activity in the U.S. And abroad. We, being early stage investors and being so people driven, we also give ourselves the flexibility to be opportunistic and back great founders doing things that we don't expect. And so, we do have an opportunistic lens too, and end up sometimes investing in, deep tech moonshot bets and hardware and things that we don't have a thematic focus on. We just, for example, announced our first investment in a quantum computing company, which is about as hardware and moonshot as you can get. We're very excited about that one. So, and then abroad, there are some similarities, I'd say, but there are also some differences. So, we have boots on the ground in Singapore and India at the early stage fund. They look at some of the same categories that we do, but they also, there are some, I'd say, categories that are more prevalent and more dominant. So for example, marketplaces are really big in emerging markets. I think, if you look back at the US's history, marketplaces were really huge in the, early waves. They're still big, obviously, but then, you have a shift towards, SaaS and other types of companies as well. And so, and then, the nice thing about being a global investor is you also start to see similar business models that are across different regions. You can start to pattern match on that. And so you might, have a company that is a D2C healthcare company in the US, and then you have a pretty close analog D2C healthcare company in India, and something about how that business scales, the economics. You obviously have to adjust it for the market, but it's nice to be able to recognize those similarities. So, you mentioned Israel. India is a very, I think, a very interesting market as well. And we do a lot in Southeast Asia. And Latin America, I'd say, is one that, we're diving pretty deeply in. And we have a China fund. So, that's kind of very specific. There are obviously some unique things to take into account when investing in China. And Europe is very active as well. I mean, that's the exciting thing about being global, is that all of these ecosystems are really starting to take root in a way that I think will be kind of really fruitful for the coming decades.
Has this environment on a macro level changed the way that you guys analyze and seed investments going forward? What has that done? Because other than, valuations certainly making things probably more affordable, that's for sure. But give me a little insight into what pivots or trajectory changes you guys might have made.
Yeah, it's a great question. And the answer is still evolving, I would say. But I'd say, we are focusing more on kind of credit quality and credit risk. If a business has that in their business model in some way, shape, or form, lending platforms and that kind of thing. Cost of capital, we're focusing more on that, just given the rising interest rate environment. So these are always risks, but of course, when cost of capital was really low and there was a lot of money sloshing around, it's easier for companies to scale. And then we look at, industries that are both countercyclical to recessions and are hardest hit by recessions, to understand just kind of what the risk profile is for a company on an industry perspective. So if you're selling to restaurants, for example, versus versus manufacturing, right, you might have different risk profiles. Frankly, we try to take into COVID into account as well. Going back to the restaurant example, right, like hopefully this is the last big global pandemic we lived through, but certainly like the effects of shutdowns on businesses have been, really impactful. So, but I'd say on the macro recession front, it's on the analysis side, it's mainly about credit risk and cost of capital. And then to your point about valuations, we try to just, be a fair and adjust to the market, where multiples are. today and price according to that.
So with cost of capital, before I want to shift the conversation a little bit to the individual investor, but when you talk about cost of capital, do you guys look at perhaps bringing in venture debt to perhaps, bring down whether it's dilution or the cost of capital? I mean, how do you manage that cost?
So there's two separate categories of debt that we deal with most commonly in startups. One is venture debt, which is usually done alongside an equity round, meant primarily to extend runway. Sometimes you have to draw it, sometimes you can keep it more as an insurance policy. And cost of capital is definitely relevant there because the interest rates are typically floating and they have gone up. But that's kind of less critical to a company's core business model, and it's more about runway and cash optimization. The second category, which is more fundamental to a business model, is debt facilities that are a company will rely on to generate revenue. So, for example, in the buy now pay later space, a company will often raise equity, and then they'll raise a debt facility that is usually much larger than the equity round in order to make loans. And those interest rates are also typically floating and have gone up. And so, your unit economics and your net interest margin in that kind of business can go upside down or stay upside down longer if your rate ticks up every time the Fed increases their rates. So I think that second category is where we spend more of our time. And the first category is more of just adjusting to new market conditions.
Great. I want to shift the conversation to the individual investor. I'm sure our listeners, we all here have had friends or folks that we know who have started businesses. They all sound very promising. They all have wild valuations. It always brings me back to Shark Tank and Mr. Wonderful and saying, oh my God, where did you get these valuations? Which I actually think is probably the smartest thing he does, because they are wild, lofty valuations that people assign to these investments that absolutely have no business. And so when an individual investor, thinks about venture, I think they need to think about the risk premia of never seeing their money again. So, Tom has a successful real estate operation where if I give him money, I know that I could probably expect a return depending on what real estate asset class it is. Whether it's a development, I could probably see a return within 12 to 24 months, right? But it's a reasonable expectation. If he's buying something that's already an existing asset and perhaps it's a value add opportunity, maybe I start seeing money within 6 to 12 months. But the expectation of me starting to see a return is fairly, short term. And so, when I look at the venture space, I think a lot of the individual investors out there who get approached in these deals, to me, it just seems like just where the risk premium is for them never seeing their money again, and what the offer is, it just doesn't seem to really kind of provide any investment value. So I'm curious to hear from you as we kind of close this up. What should individual investors do in the VC space? How should they access it? And what are some things to look for? Obviously, you're not going to get into everything, but perhaps 2 or 3 items would be really helpful for our listeners. Yeah,
that's a great question. I mean, I think, the first thing most people talk about when it comes to individuals accessing VC is as an angel investor. And I think given what you said about the lockup periods and the illiquidity, as well as what we were talking about earlier in venture being a hits-driven business, you want to make sure you have a diversified enough portfolio to have a chance at hitting a winner or two. So typically 50 plus investments over 3 to 5 years is I think a good place to start. I think what's really risky is investing a high percentage of your net worth into 5 investments, which all could go to zero. Just not enough diversification, especially as an individual angel. where you might not have the brand or of a firm behind you and whatnot. You might not have access to the same deal flow. You might be dealing with more adverse selection than if you were the same individual at a firm. So I think, kind of diversification and portfolio sizing is really important for an angel if you're going to go direct into startups. The other way to gain access is like there's crowdfunding platforms. I'm sure you're familiar with most of them. I've not really been a fan of that way, primarily because I think there's a lot of adverse selection on those platforms.
Give us an idea of what adverse selection is. I know what it means. Tom knows what it means, but break down adverse selection and what that looks like. What's the negative benefit or negative risk to the investor?
Yeah, I mean, basically just meaning that like the best companies will often not list themselves on the crowdfunding platforms, and they might not, you might not ever hear of them raising. And if you do, you might not be able to get in as an individual angel with a small check. And so when you're looking at companies on a crowdfunding platform, you're probably looking at a universe of sub 5% of companies. And the other 95% really high quality companies are going right to institutions or to established names to raise. You're never looking at them. So you may look at a study that says, oh, if you invest a certain number of dollars in as an angel into venture, it's offered great returns and all these things, but that's assuming you have access to the whole universe. So adverse selection, I think, is it's a sliding scale. I mean, we deal with it as well. But on one end, if you're Sequoia, right, you deal with less adverse selection, and if you're an individual that no one's ever heard of, you deal with more. So typically what I'd recommend is like you want to try to just minimize that as much as possible. So whether that's focusing on a domain that you really know, or focusing on relationships that you already have in your network, so that the reason you're seeing it is because of your relationship, not because no one else wants it, is really key.
Morgan, thank you so much for joining us. Tom and I are going to sit here and debrief, and we really thank you for taking the time to educate myself, Tom, and our listeners. And we hope to have you back on and chat more. And we'd love to hear kind of some of the success stories that you're able to share next time. So cheers to you, and say hello to the wife and kids.
I will. Great to meet you, Tom. Thanks, Mitch. The invite was fun, and look forward to doing it again.
You got it.
Take care. Tom, pretty interesting feedback and information from Morgan. I'm curious to hear what your thoughts are on overall the venture space.
Yeah. So, the last thing he said, I think can be applied to, for the most part, any industry, right? I mean, even in real estate, we're not going to, I don't go out and try to figure out how to do industrial. So I don't know it, right? So he, I think what he says is smart. If you're not a big name brand like B Cap or Sequoia or Andreessen, you're going to have to become a master of your domain to find the best companies that are probably in the blogs that no one's talking about. Right. So
to echo what you just said and what Morgan just said, I think, it's absolutely right. If you're going to be an angel investor, seed investor very early on, I think you can't just be a passive venture investor. Go buy a micro small cap ETF or a small cap and get access to the market beta that way. Unless you can be a strategic investor, in my opinion, and actually have an outcome or an effect on the outcome of your investment, I think that's the way to go. There's nothing cooler than going to a game and trying to have an effect on the game. When we're investing in the stock market, we're really kind of spraying and praying, if you will. But if you are an expert in whatever domain it is that you exist in, for you, it's real estate. And somebody comes to you with a real estate idea, perhaps it's some sort of a real estate tech idea in order to optimize the way that you do business. You might have an interest in that. You might be able to help facilitate that growth, minimize that J curve.
Yep. Yeah. But again, I mean, it goes back to knowing your domain. I mean, I get deals all the time that are RV parks and places in different states. I mean, I don't know what I don't know. Like what? So I stick to my guns, right? And obviously, Morgan's, again, B Cap has the benefit of having a long list of high quality deals. But as you mentioned, as a small angel investor, right, you would look at 50 deals before you invest in one. But think about, I mean, he could do 1/10 the amount of work. Your underwriting has to be way more long-winded for you to be able to successfully, or I guess, more appropriately deploy your capital. So, that's a really important part. I thought also, interestingly enough, we know the valuations have plummeted, more than half of what, 25, 30x multiples on top line have come down to more grounded levels. I would have loved to have known what he thinks the future holds. Do we get back to those valuations, or are we going to be sticking in the 15, maybe 20x multiples for time to come?
That's a great question, and probably I'd say the $1 million question, but you could probably turn it into a $1 trillion question. Yeah. There's a lot of folks saying we're not out of the woods yet. I personally don't think we're out of the woods. I think things are definitely going to take a bigger hit, but let's see. Obviously, when we look at direct real estate deals, a lot of smoothing, a lot of lagged returns, a lot of lagged pricing. I am seeing a direct negative return in multiple markets. Obviously, the stock market had a bounce back, and now we're kind of going the other way. I'm still uneasy. I don't feel great about it. And I think I'm trying to be as realistic as possible of the effects of the Fed just continuing to raise rates to lower inflation, but I think it's going to stop the economy dead in its tracks. Yeah. And I think that is a major, major problem, that we're just so myopic on stopping this one leak in the economy, if you will, and we're going to go to that one leak. Meanwhile, there's about 6 or 7 new ones that are sprouting out. Yeah. And I'm just very concerned that we're going to be heading the wrong direction. The best news, and I've said this forever, the consumer, the individual investor is in pretty good shape, although all the sources are saying, the credit card balances are going up. But for the most part, people are going to have jobs. I work for myself. I can go back and do what I did tomorrow. Right. Yeah. And have a nice 6-figure income. I could go wait tables. I could go Uber. I could do whatever it is and make money.
Yeah. Yeah. I mean, I just, last night I was on a spiral watching Chamath, watching Munger, watching Peter Zion, all these top thinkers talking about where we're at in the globe. And, it's the disconnection of globalization. It's the global inflation. It's China having a massive issue right now. It's Russia imploding, at the same time, supply chains constrained. And meanwhile, a lot of our inflation numbers are coming from rent and energy, which great. Increasing rates doesn't do anything for rent. You have to build more to drop the rents. That's going to be a problem if costs go up for borrowing. Oil is going to be high for some time, right? Now gas is probably going to go higher. So inflation's here to stay for some time. It's interesting though to see the Fed just completely destroy demand in hopes that somehow nat gas, oil, and rents all come down. And I just don't see a world in which that happens for some time.
Yeah, I mean, again, I talk about elasticity of supply and demand all the time, specifically as it results in real estate. It's probably less elastic, or I'd say more elastic in the energy space. But where I'm going with this is, alternative energy starts to ramp up quite a bit when we're in these environments, and then you get to that kind of inflection point where it meets the intercept, and voila, now all of a sudden energy is cheap again. So it's this constant yin-yang effect, but I think it's just being super myopic about this one area. And, there's a term called Dutch disease, which refers to the Dutch earning a lot of their country's wealth through energy, and it hurt other industries. And where I'm going with that is it's not necessarily Dutch disease. It's almost the reciprocation of, or the inverse of it, where we're so focused on this one area. I think we're going to get blindsided in this economy. And it's something that we really need to pay attention to. But I don't think the Fed is, they just don't seem like they're handling it well.
It's interesting, right? I think if you take out, fiscal policy and monetary policy, right? So the government with just recently with the student loan forgiveness, that's a $300 billion give, right? That's massive, absolutely inflationary, right? Among all sort of other cultural issues that it's going to cause, but and how fair it is to essentially push out the blue collar guys who have loans too, but whatever. Yeah, go ahead.
Can I stop you right here? Because you brought up something that really kind of annoys me quite a bit.
Yeah.
You have people that went to school, they knew exactly how much it was going to cost. They're educated people. And, you've got this bailout to help these educated people when we've got record amounts of homeless people who can't help themselves, who would have far greater impact, in my opinion, if you focused on them or open up the borders a little bit. And, I'm not going to get political. I'm just going to be economical, but there feels like there's better way to spend that money is all I'm going to say.
100%. And Shamoff came out and kind of broke it down wonderfully. He said, look, back in the day, college had an ROI. Pretty straightforward. You spend 10, 20 grand, you come out making $40,000 extra per year. It made sense, right? When you forgive the debt like they're doing, all they're saying to these institutions is jack up the rates. You just paid off all of their investment to these students. Their endowment funds are going to grow. So you just gave all that money to the Harvard endowments, the Yale endowments of the world, which is, that in my mind is fascinating. But $300 billion, aside from which party you're on, that can solve a ton of issues right now. And we're just going to give it away to inflationary pressures that have really no impact. I'm blown away by it. My point is, without getting on a tangent too much here, you have a disconnect from what the Fed's trying to do and the government bills that are very much inflationary. And we're disconnected. And I don't see a world that we start going down in rates for about 12 to 15 months at least.
Yeah, it's going to hurt us. I got to tell you, in the last 12 months of us doing the podcast, I feel the most organized we've ever been. I feel like the content looks better. You look great. I don't know what kind of moisturizers you're using.
It's this new camera. I had this plug for the free plug, by the way. This is the Lumia. About the same price as the Brio, but yeah, really phenomenal.
Well, you've got excellent skin. You look like a 28-year-old.
Try, man.
I really like the format that we had today, where we had a subject matter expert in a non-real estate focus asset class, and gives us some context into that, because individual investors always want to know, hey, I want to hit a grand slam too. No, you don't, because here's how we're going to wrap this up, by the way, because what he said, and this was so fascinating, this is a $250 million fund. He said one company is going to make that fund, or at least that return of that fund to the LPs, make it all worthwhile and get that, 10, 20x, which means 34 of them really probably aren't going to do much. He said, some of them might do, 1 to 3x, which means we'll be lucky if we get our money back, right? Which doesn't do anything. And then most of them are going to be dogs, which is so wild to me. I mean, this is a company, if you go to B Capital's website, look at the amount of Ivy League and educated.
Yeah.
They got everybody. And plus they've got Boston Consulting Group. And they still, if you take that from a batting average perspective, I mean, it's worse than Joey Gallo. Forget about Mendoza. No. And the Mendoza line, it's well below that. Forget about having success as a weatherman, being 50% accurate and 50% wrong. You're talking about 1 out of 35, that success rate that's bonkers. Yep. So that to me says stay away, because you have a 3% chance of success and what are you left with? I will say that although these guys may think they have the best access to deals, and which they very well may, right? I mean, there is performance persistence in the VC world. You could say that funds that have had success, follow-up funds, tend to continue to have additional success because, it just starts to attract different capital. So if you're getting courted by some of these large VCs, then the other ones come into play, and it's kind of, this herd mentality. And so, yeah, there might be some self-fulfilling prophecy.
I mean, what you see though, right? Like you see that when there's a leadership team that has a win, that's recognized. And a lot of the people that I know have been funded by these bigger companies, Sequoia, Andreessen, B Cap, their previous leadership cohorts that have already exited successfully. And so when we ask them the question, what's the number one variable, we look at people, because if they have a proven track record to this scale, the chances of that 3% probably go to like 15, 20%.
But I'm curious to actually look at the data on the follow-up companies of founders having additional, success. Obviously, Elon Musk is, a great example of that. But I am curious. I really am to actually see the data of founders, but I think it's more the ecosystem, right? Ideas are a dime a dozen. Execution is something completely different. And then adoption is something, so you add in the factors, all these, the founder and the quality. And timing, right? The vintage, right? Because there are ideas 10 years ago that were moronic that are probably coming to fruition and anyway, would be great investments today. So, as the individual investor, these crowd sourcing platforms from a venture perspective, to me, they're just filling buckets. And, is there some analysis and perhaps some quantitative metrics that you can have? Sure. But, when you look at these crowdfunding platforms, is there really some strategic investment going on? Are these folks at these crowd funding platforms, are they taking a board seat? Are they helping these these companies actually succeed? I wonder about that. I'm not saying one way or the other. I just wonder, but I really enjoyed today, Tom. I think 100%. We kind of found our niche and to figure out continually kind of to repeat this process. To our listeners, we kind of just get on here and wrap what's ever on our mind without some real, structure. But I think when we put a little bit of time in to the research and getting high quality folks like Morgan from B Capital, I think it gives us some stuff to talk about and to be a little bit more educational. So we hope to continue to provide great content, education for you guys. You know where to find Tom. His website is right there. I'd love to hear from you. You can find me at mflax@netequitycapital.com. I'd love to, chat with any folks who are interested. I love talking about investments. People always say, Tom, hey, I don't want to talk about business anymore. I don't want to talk shop. You ever hear that?
Oh, yeah.
You know what I tell those people? You're in the wrong shop, pal, because you're not having any fun. All right, man. Till next time. Thanks for listening.
Yep.